Hey everybody, it's Chris Buteau with Cleveland Street Mortgage, and today I want to talk to you about prepaid interest. Just to explain what that is, sometimes it's a ill understood item on the closing disclosure on your loan estimate, and it can be a significant number. Here is section F of the closing disclosure on page 2 under prepaids, and you have this item called prepaid interest. And on this example, it just happens to be $39 a day. That's just the interest cost of your loan. So whatever your interest rate is times your loan amount divided by 365 days is your daily interest charge. And whenever you're closing on a new loan, you're typically going to have an item called prepaid interest. And the question kind of arises, depending on what day you close, this number can go from $39 to $1,600. And what is that? Is that extra fees that the lender's collecting? What's the nature of that item? Why does it vary so much depending on what day you close? And to understand that, you have to understand how mortgages work in general. And so I've got this timeline here, and this is just showing due dates of a typical mortgage. Mortgages are technically due on the first of the month. And so, if you have your mortgage, your payment's going to be due on January 1st, February 1st, March 1st. Now, you have grace to the 15th of the month. So you can pay as late as the 15th of the month as long as your payment arrives to the lender. No penalties, no extra interest, no problem whatsoever if you do that. But technically, it's due on the first of the month. But interest is collected in arrears. And so here you see that when is the January interest going to be collected on your mortgage? Well, it's going to be collected with the February 1st payment. And so when you make that February 1st payment, you're paying interest that accrued during the month of January. So, January 1st, you had a principal balance outstanding, and you were accruing interest every day based upon what that balance was and the interest rate. And so when you came to make that February payment, most of us have what they call fully amortizing loans. So you're paying it off over the course of 30 years, say. And so every month you're paying some principal and some interest. It's amortizing off that balance that you owe. But the interest portion accrues during the prior month. And so you make that February 1st payment, you're paying interest for the month of January. And in here, let's say you make that February or that March 1st payment, that's when you're paying interest during the month of February. So the question comes up, what happens when you buy that house or you refinance? But let's say this is the context of the purchase. It's a little bit easier, I think, to illustrate that way. You purchase that home in the middle of a month. What happens then? And so let's look at this example here. Let's say that you close on March the 2nd. You buy a new house and you close on March the 2nd. And in this case, the lender is going to collect prepaid interest for 29 days. March has 39 days. And so from the day you close on March 2nd to the end of March, they're going to collect this prepaid interest. And the reason for that is typically, when you finance a new home, when you take on a new mortgage, you're going to skip that first month's payment. And the reason is most lenders don't have enough time to get you in their system, get you all set up, send you a statement, and have you make a payment in time. And maybe they'll have enough time if you closed on March the 2nd, but maybe not on March the 10th. And so rather than deal with that on an individual basis, typically they're just going to skip this April 1st payment, and you're going to start making your payments on this new purchase in May. But this lender still wants to collect interest for that period of time in March that they loaned you this money. So it's not an extra loan fee like a title or escrow or appraisal or credit report, all those transaction costs to get the loan. This is just normal interest on the loan, but they just collect it. It's called prepaid because they collect it in advance of when it's accrued, right? The day you get this loan on March the 2nd, you don't owe any interest yet, but they collect it so that you can skip this payment. And then you start your 30 years or your 360 payments here on May 1st, and they're just collecting interest back here to April 1st, just a normal first payment, and not some oddball first payment where they go, well, really, you started here on March the 2nd, so we want to collect 58 days worth of interest with this first payment, and then 359 other payments that are normal. And then, so what happens here, what if you close toward the end of the month? And this is why this number can vary so much. And it's not that the cost of this loan is radically different if you close on the first of the month or the second month, but technically these are called settlement costs. And so this interest, even though it's just interest on your loan, is included with the appraisal and title and escrow and all those other actual fees to get the loan. And so it can appear that your costs are actually higher, but really what's happening here, if you close, and I can see I didn't change that number. What happens here is if you close on March the 30th, now you only need 1 day of prepaid interest, because again, you're still going to skip this April 1st payment. You're going to start making payments on this mortgage on May the 1st, but you only have 1 day that you have this loan during the month of March. And so you only have 1 day to cover with this prepaid interest. And that's why this prepaid interest number can go from $1,589 all the way down to $55, depending on how close to the beginning or the end of the month you close. So I hope that helps clear up some things about prepaid interest. Thanks so much.